Right. Are there any questions or comments from the audience? There are still some time, if you like. There's one gentleman in front here. First there, and then second, Rector Olsen.
Thanks, Jamie, for this great talk. You briefly touched upon the interest rate question, in our private conversation. So could you just sort of give us a little more sense of how this interest rate is the sort of mechanism by which finance begins to play the role?
Well, I think one has several things going on. One is the extent to which, let's say, global financial markets globalize, and that is the openness, which is particularly great amongst the smaller countries. It's the large countries, the China, the India, the Brazils, that maintain capital controls. I have to say my one contribution to the well-being of China during the time I was working for the State Planning Commission was to recruit Robert Eisner, a figure of considerably greater weight than myself, to talk them out of liberalizing the capital account in 1995. So when you have a situation in which the indebtedness in that system has gone up and the debts are such that they are tied to flexible interest rates, then when Paul Volcker raised the interest rate to 20%, the base rate in the United States, well, the wheels of the world froze. The banking system then went into reverse, and everybody either their economy crashed and ultimately they defaulted. And that created a essentially dysfunctional environment that affected countries according to the strength of and the ability of their institutions to resist. The developing world, Latin America and Africa, was vulnerable. And they had to adjust by crashing imports and deindustrializing. Central and Eastern Europe and the Soviet Union were strongly affected. Poland was in debt. Russia was in debt. But their institutions lasted another 5 or 10 years. And then the Asians were hit in the late 1990s. So it seems to me to be an integrated explanation in which the interest rate plays an important role. But it's not the sole factor. It has to do also with how much debt is affected by global interest rates and how much protection societies have from that kind of influence. I strongly believe in the importance, therefore, of large countries maintaining capital control and of smaller countries forming unions, financial unions, to protect themselves and stabilize themselves so that they're not being governed according to the whim or the domestic policy purposes that may emanate from New York or London.
Thank you for a very nice talk, and I shouldn't probably pose a question because I'm not an economist and not
Don't rub it in.
a political scientist. But you made it quite clear in your presentation that the financial sector is of importance with respect to the inequality and how that drives. But to me, it seems also that there's a limitation to what the national regulations of the financial sector are able to combat these. So what do we do then? Because national governments obviously only have the responsibility and the possibility of national and local regulations, but that's not sufficient, is it?
It's definitely necessary. A national regulatory structure, international regulatory structure needs to be in place. Well, my view of the matter is very simple. That countries can be run by governments or they can be run by banks. Banks don't do a very good job over the long run because they're representing their own interests, which is understandable. And so a deregulated banking sector is like running a reactor without coolant. It will blow up in a short period of time. Right? And the evidence for that is history is littered with that evidence. But I think that given the degree of integration of the global economy, that regulatory structure really does have to work at a higher level. It would be nice if it worked at the same level as the banking system itself, but that's hard to achieve because of the unwillingness of the major banking countries the US and the UK, to participate effectively, right? Which they regard their banks as instruments of predatory control of the rest of the world. And so, therefore, it really has to be done at the regional level by very strong institutions of countries that where the political economy is more balanced. That would be, I guess, my response. And definitely, anybody who's studied Hyman Minsky knows that there's no permanent solution to this problem. A period of financial stability breeds instability because anybody who has capital in a long period of low yields reaches for yield, goes out to take more risks, brings in debtors with a higher propensity of default. And sooner or later, the system is going to become destabilized. But the object of regulation is to keep it going smoothly as long as possible. This is not unfamiliar. Anybody who has a car knows that you maintain your car, it doesn't run forever. You maintain your reactors, but you decommission them after a certain period of time. Failing to maintain the car or the reactor, on the other hand, is not wise policy. And the same is true for a banking system. I think actually that metaphor is really quite precise. And it's also the same for those of us who have to regulate our blood pressure. I mean, it's not going to succeed forever, but the point is to make it work for as long as possible.
Thank you.